Okay, so welcome to Nielsen IQ's Retail Pressures and the Consumer. I'm Steve Zurich. I'm the Director of Sales Development for Nielsen IQ. I come to Nielsen with a deep experience level in CPG with companies like Procter & Gamble, Pepsi, Gillette, and most recently GSK Consumer Health, which is now Haleon. And I am accompanied today by Daniel Perez, and he is our Vice President of Consumer Intelligence. He is an CPG industry veteran as well, with companies like Procter & Gamble, Heineken, and Walmart. So we've got a pretty packed schedule today, so we're going to get right into the presentation and start talking about the consumer and how they're feeling. So the interesting thing for us is that not only are we analyzing this data, but we're also participating in the economy, and we're all feeling these pressures mounting on our wallets. Rising grocery costs are something that's happening literally every day and is continuing, although we're seeing some leveling off in certain categories. Fuel costs are still relatively high, although those are coming down as well. But then we're seeing things like utilities and interest rates continuing to move forward, and supply restrictions are still some things that we're dealing with. And even though it feels like we're not in a pandemic anymore, we still are. And even though it's effectively minimized in the United States, outside of the United States, it's quite different. And you've got countries that shut down ports based on infection rates and trying to get control. So that's creating some supply nodes that are moving through the supply chain. So, it's creating some instability there still. We move to the next slide. So let's just level set a little bit on what's going on with the economy. So consumer confidence is still high, although this number is coming down as well. But it's still showing that consumers are comfortable with spending in the economy. And that's really been driven by a couple of things. Well, the main thing, which is unemployment. So as long as households are still employed and there's still cash flow coming into the household, they're still willing to spend. They're complaining about prices increasing, but until that number starts to change and starts to get higher, we're going to see shoppers spending in the stores and online. The savings rate, we did see some very aggressive saving through the forced isolation that we experienced when the pandemic was at its height. For the first time in a long time, the US actually experienced double-digit savings rates, and that has slowly been coming down. And actually, we're getting very close to being pre-pandemic level on consumer debt, so consumer credit cards primarily. And the stimulus money that was in the economy 18 months ago is not here now. So whatever was put into savings accounts as a result of receiving that is now coming out because prices are increasing. Average wages are going up, but they're not keeping pace with everything else that's going on in the economy. So what's making us feel a little better? Well, we kind of have a short memory of where gas prices were 6 months ago. We were on average a little over $5 in the United States, and now, we're down to $3 and change. I think the latest number is $3.40 a gallon, national average. Obviously, that regionally flexes whether you're on the West or East Coast or whether you're in an urban versus rural environment. But for the most part, we are seeing some declines in fuel costs. So what is that doing? Well, that's adding about $58 per month per buyer or per driver back to their pocket. So 2 drivers in the household, that's almost a grocery bill that they're getting back. We still have a lot of jobs that are that are out there, but we've got more jobs than we have people to fill them. So there's about 2 candidates for every, or there's 1 candidate for every 2 openings. So, you know, we have a lot of employment opportunities out there, and that does lead to a little bit of promiscuity in terms of, you know, how loyal are employees really being to the company that they're working for. So, you know, if they know that there's another job out there and they're dissatisfied, it's more likely that they will just move to another opportunity. And that right now, that's still something that that can be done. So when we looked at consumer price indices across the country, we are seeing declines in a lot of different areas. So, you know, we are seeing declines overall. We're seeing declines in energy, food, and eating at home. Restaurant eating outside of the home is still something that, you know, we were released back into the wild in terms of, you know, coming out of isolation with COVID, and so there was, you know, some spike in external eating habits, and that's still sort of out there because we want to socialize and we want to be with friends and family out at restaurants. But the expectation is that as we move into whatever the next phase is of the economy, which is likely going to be a soft recession, you know, that will start to contract back into the home, and that's all normal. So what's been contributing to price appreciation? So for the most part, we've really seen non-promoted price contributing the most to price appreciation, and we've been given a tremendous gift actually as an industry, CPG industry. You know, all of us have experienced parts, you know, of our careers where, you know, maybe a brand we were working on was pulled off the shelf for whatever reason, and so, you know, our promotions for that brand went down to zero. But really, this is the first time in history where promotions across an entire industry have come down to almost zero, and that's an opportunity and a gift for the main reason that it's an opportunity to get rid of all of the promotions that just were not providing any return on your trade dollars. So going into the pandemic, we had about 75%, 73 to 75% of all trade dollars spent in CPG were not returning on the investment. So why would we want to sign up for that? Personally, we would never sign up for something that, you know, only has a 25% chance of being successful. So I don't think we should really necessarily be signing up for that as an industry. And this is the time to take to redesign how you're going to come back with promotions going forward. We are still seeing some distribution challenges, and that's taking some things off the top. And then demand and promotion a little bit is driving you know, the price appreciation across all of retail. And so we've looked at promotions across a variety of different major categories. And the one thing that really stands out is the level of subsidized volume that's going on within promotions. So subsidized volume is that volume that you would have gotten in the absence of a promotion. So some of the categories like bakery, alcohol, meat, produce, seafood, a lot of fresh categories, there is a significant amount of subsidized volume that is sitting in that incremental part of this analysis. And so, you know, what does that really mean? Well, it means, one, you don't have to promote at very aggressive, very deep levels, and you don't have to promote with much frequency. But two, you're really leaving money on the table if you are promoting, you know, at this point. So, you know, promotions are going to be coming back. They're going to have to come back, and we'll talk about some of the reasons for that in a couple slides from now. So the big question of the day is price elasticities and the benchmarks around that. And so, what we've seen is there's really not a lot of consistency, across the different categories. There's ranges, and the ranges are somewhat expected at this point. We've got several categories where the price elasticities are actually declining a little bit, and that seems counterintuitive, but thinking about that a little bit more, the entire ocean for the most part is rising. So, when that happens, price elasticities tend to stay just like they would in a calmer market, because everything else is being held relatively the same. So, it's worth understanding what your price elasticities are by category and by your brand, because that is going to determine what your pricing strategy is going to be, both on everyday price as well as promoted price, and how high you can go. Now, how high is too high? That's the question. And really, there's still room in the economy to do that, because if we circle back to the unemployment rate, which is really low, shoppers are still going to be able to absorb some of the price changes that are going on, in the categories. Now, the question becomes is, at what point does that start to feel like price gouging? Well, I think a lot of people are feeling that right now, and there's a lot of talk in the news cycles about that. And so, as a company, you want to be careful about how high is too high. And really, at this stage, it's about making choiceful price changes, not necessarily how many you can make across the year. You really have to forecast better. And luckily, we're getting to a point, or we're at a point now, where our forecast can be a little bit longer. A year ago, or even 2 years ago, it was a nightmare to forecast. In fact, there really wasn't any way to forecast, because things were changing so fast and supply chains were so erratic. But as stability starts to build into your supply chains, your ability to forecast for longer and longer periods is starting to return. So, understanding price elasticities and understanding, all the different elements within your forecast model is pretty important at this point. And so what we're seeing across the stores, we're seeing average items carried going down. We saw that happen during COVID, and that was natural because we didn't have supply that could keep up with the extreme demand that we were getting in the COVID time period. But one of the things that was learned during the COVID time period was that, and what was trained is, we trained a large number of shoppers about the internet and about buying things online and considering buying other categories online that they normally would not have pre-pandemic. And so what did that do? Well, that educated them on the fact that depth of assortment lives online, right? So, as supply got back, kind of starting in Q1 of 21, and then we were able to maintain supply after everybody had enough toilet paper and enough paper towels and all those things. We started to see retailers pulling average items down a little bit, and the reason for that is because they are trying to manage their inventories. They're trying to manage a footprint. And the realization that there are some things that are sitting on shelves that just don't move, and they don't create any incrementality. They're not bringing in a different shopper that might be more valuable to the retailer. Those are the kinds of brands that are starting to get rationalized, and it's going to be really difficult to be a one SKU brand going forward, because you're going to have major retailers that are going to be really looking at their assortment and the amount of space that they're dedicating to categories, and they're really going to rationalize that for the higher velocity items. that they know will sell. Now, the other challenge that is presenting itself is really, when we start thinking about bringing innovation or bringing new items to the category, it is going to be more important to come with really rich data behind your innovation, because a category manager at a retailer their sole job is to mitigate risk for their retailer and for that category. And so if there's an item that's on the shelf that's a known item, it's selling, they know more about that item than taking a bet on a new item. So the new item that's coming in really you have to justify that. You have to prove that it will perform before that retailer is going to be taking anything off the shelf that they already know what it does. So what are retailers worried about? Everybody's worried about holding inventory. There's not a news week that goes by where, especially when we get through the the earnings cycles for publicly traded retailers, where we're not hearing about what's going on and what they're feeling in terms of inventory. So Target just reported their Q3 earnings. They still have some inventory that they're burning through. Lots of other retailers are in the same exact boat. They're hoping that the holiday season is going to burn some of this off. A lot of it is in general merchandise, and there's been, where you've got retailers that have more of a GM side to their business. Some of that inventory that is sitting there is probably going to be fire sale kind of a thing. And there's less of an issue at in grocery, but because that's out in the market, because retailers know that holding inventory, and especially inventory that's not moving, is really dead dollars on the shelf, they're going to be moving through this and concerned about it, even in your categories. The other thing that's a challenge, and if you want to move to the next slide, is labor. So retail turnover is second only to the hospitality industry in terms of turning over labor every year. So if we were to look at retail turnover in 2020, that number was about 54%. In 2021, it was almost 65%. There's lots of promiscuity in the retail sector in terms of moving from one employer to another. That is because of the unemployment rate being so low, and it's causing a problem. In terms of how do you redeploy labor across the store that you still have, because there's been some new shopping missions that have occurred as a result of the pandemic too. We've got click and collect, which is either the shoppers coming in the store, they're getting a curbside, and then you've got to have people that are picking those orders. So you're seeing technology rolling out. Now, a lot of the technology was rolling out prior to the pandemic. Even an off-the-shelf technology is going to take a couple of years to implement, but you're seeing some changes in the remodeling of the front end of the store, where you've got more self-serve aisles, and retailers are funneling shoppers into those self-serve aisles as opposed to the full service checkouts in the middle. So, until the labor shortage gets corrected, and it may never get corrected, or it may be very slow to be corrected, technology is going to continue, to be a bigger and bigger part of the retail landscape to augment what's being lost with humans in the store. So some of the ways that retailers are responding to this is, they're continuing to take price. Fine-tuning their pricing strategy, and either using tools to create more dynamic pricing strategies and algorithmic pricing strategies, And that's really the advantage, actually, to what we saw online, is that we didn't see as much price appreciation online versus in stores because those algorithms were keeping things fairly tight. We're going to see more investment in tech and automation. Artificial intelligence is coming online, especially with food retailers that are testing a lot of different systems. A lot of things are in beta right now, but they're using automation to really look and see what's the inventory on the shelf and where are out of stocks happening. So there's an augmentation that's going on there. Prioritizing the private label, that's nothing new. The challenge for you as a brand is knowing, do you know what your price gap is to private label and what an effective price gap is to private label? That's a very pivotal thing to know, because that's going to drive to a degree your promotion strategy. And it's going to also, you're going to be thinking about, what is my innovation strategy and how do I keep private label at bay? And then, determining assortment, is another piece. It's not necessarily about depth of assortment anymore. It's about the right assortment. That's the question that you have to ask at retail. The other question is what's the dialogue that your brand is having with your shoppers or with your consumers? And then what is the dialogue that the retailer wants or needs to have? Because, if you've got a steady increase in click and collect or click and curbside, you have a shopper that's not actually coming into the store anymore. So they're not being distracted by impulse brands or impulse items. Everything that's sitting at the cash wrap is not being seen by that shopper. They're coming in and out, or they're not coming in at all. So, the ability for your marketing to speak concisely and be more hard-hitting is going to be critical when those shoppers are in the store. So we've got a lot of different questions that retailers and manufacturers should be thinking about. But really, this is the point, where, and I'm happy to see, as being in this industry for more than 30 years, one of the things that I was always looking for, but was never really there, is that predictive capability. Give me a crystal ball to the future. Well, now predictive analytics has become more and more mainstream. So having the ability to price your items correctly, making sure you're not leaving money on the table, being able to pivot quickly enough to, understand your assortment changes and what they're doing and what your promotion strategies are doing, is really critical at this point. And there's lots of different things that you can be using as an industry or as a company to answer those questions. So I'm going to turn it over to Daniel now, and I think he has a poll we're going to go through.
Yep. Hello, everyone. Thank you, Steve, for sharing all the different challenges retailers and manufacturers are facing. And as we know, consumer behavior changes have already happened. And what we need to know now is how smaller wallets are impacting your categories. And among the key questions that Steve shared, here we have the top 4 that we hear over and over when we have client conversations. And I'm going to ask Lee to create a poll so we can hear from you. We want to understand from these questions which topics or which questions is the ones that you are hearing among your team peers, hearing from your retailers or within your organizations. So we're going to take a minute here, 60 seconds to go over that poll. So Lee, just let me know when you have this on so we can have everybody clicking and voting on the question that they feel is more important. And in the meantime, I'm going to ask Steve, since he's our expert on inflation, a couple of questions. Would that be okay, Steve?
Yep, that's fine.
Perfect. So we were discussing inflation with many clients, and one question that we get over and over is, what about innovation? Is this the right time to drive innovation? So what are your thoughts about that, Steve?
Yeah, innovation, you need to keep driving innovation. And innovation is serving two purposes. One, it's continuing to secure your place on the shelf. If you're not innovating, then your brand is slowly being eroded by private label. And in some cases, brands are also the private label manufacturer. But for those that aren't, you need to continue to innovate, because otherwise, you're just starting to lose your distribution, at shelf. And what we've seen is that companies that are innovating and innovate through recessionary time periods, they actually grow their total distribution points, versus the companies that don't, that maybe put innovation on a pause. They tend to lose distribution. And innovation doesn't have to be something that is, a big, something big. It could be you're going to implement a sustainability play. So you're going to change packaging from, petroleum-based packaging to paper, or, refillable containers, or things like that. As long as you're showing to the consumer and to the retailer that you're innovating, it's always the right time to do that. It's just, maybe this time you don't have to spend as much money to to research what the next piece of innovation is. It could be just an augmentation within your brand portfolio.
Perfect. And if I am a growing company and I want to basically distinguish myself with a retailer, what is the right play to do right now?
Well, the main thing is, with a growing company, one of the things that you really want to understand is, you want to understand your contribution to incrementality to the category. So if you have a brand where you're incremental to the category, and you're bringing a shopper in that maybe that retailer doesn't have, or it's a shopper that they want to develop, that's a great place to be. Just showing what the value of that shopper is within the category sometimes, can be a little underwhelming. But when you start looking at the value of that shopper across the store, and the retailer realizes that, hey, this person that you're bringing in is much more valuable to me as a total retailer, that's a really interesting place to be. The other thing is that you can't be a pain in the neck to deal with.
Right.
If you're a small brand, right? If you're a small brand, you need to, the best way to get your foot in the door into, even a large regional retailer, is you have to be able to understand their process. You have to understand the category. You have to bring numbers in, because there is nobody, the category managers, they just don't have time to babysit somebody that is not versed in the category and their processes.
Okay, so what you're saying is, it is a time to basically be able to answer questions for the retailers and be a partner, and being able to play that business planning process with the retailer.
Absolutely. And as organizations, your salespeople should be continuing to get better versed at talking about consumer data, talking about shifting and dynamics that are going on in the category, because absolutely every person that is customer facing should view themselves as a resource to that customer. Category managers just aren't getting out of their chairs anymore and getting into their stores. You are literally their eyes to the world.
Perfect. And that's actually very important, because when we look at the results of our poll here, we closed that when we had a little over 75% of the people responding. We noticed that 40% of the people participating in the call are experiencing all of the problems that we are identifying in the industry. And roughly 10% want to understand what is driving the changing dollars. So I'm going to just change gears and share that with the market summary report. You can quickly see how your consumer trends are tracking versus the category average. and your competition. And this is going to allow you to answer questions like, are your buyers purchasing your products more or less often than before? And this is something that Steve mentioned about promoting, and this is may being a lever on how your products are being purchased. And actually, you want to understand how this is comparing to your competitor, because it is really important to understand the lay of the land of your category. Because as Steve mentioned, when you are talking to a retailer, you need to be able to understand and talk about what is driving the sales trend in your category and whatever number you're seeing in scan data and what are the implications that may have in your brand. Because remember, the foundation blocks that we all know about volume, those haven't changed with inflation. Still is volume, is buyers, so your penetration, the number of people that is buying your brand, times frequency, which means how often is your product being purchased and what is the quantity that's being purchased. And the last component will be the price. So those are still the same, and this market summary will allow you to understand that. The other question that we hear over and over is if the customers are shifting to low tier brands. So once you know the fundamentals of your category with the market summary, you can take a further look at your landscape and see how buyers are shifting about brands in your category. Are you seeing your buyers moving to more value brands? And this is a trend that typically happens in these inflationary periods. Or maybe you are one of the privileged companies who are in that position where people is shifting to you. But regardless of the answer, you really need to understand where buyers are coming or going from. Why? So you can work to retain them or know where to dive in to win those buyers back. Because it is very important to know this shift of buyers between brands, especially in these times, to basically capitalize on the opportunity. The third question we ask is, what will happen to your volume if you take price? So the most important analytical capability during these inflationary times is understanding your consumer sensitivity to price changes. As we talked before, price inflation is at an all-time. And we have seen many manufacturers who are already on their second, third, or even fourth pricing action within the last year or two. So how much headroom do you have? So there is a risk for your brand's long-term health, which is continue to take pricing without understanding how your consumers will respond. What are those potential thresholds in the market, or what strategies you need to put in play as your competitors are also taking price? So being able to understand inflation and pricing and elasticity is really important. And there are tools that can help you understand that piece. And the last piece is when we think about assortment, and we know that there are now omni shoppers that are buying in both spaces, still brick and mortar is a big component of the sales. So in addition to optimize pricing, brands need to be very, very concerned about protecting their distribution. Because with all the price increases that we're seeing in the market, volumes are really challenged, and retailers are continuing to look for operational efficiencies. And this is coming in the form of reductions, distribution reductions. So here the call to action is do not wait and enable your teams with best-in-class assortment optimization tools. Why? Because you need to communicate to your retail partners the strength of your brand. But most importantly, and I guess I cannot emphasize this, the most important piece about understanding assortment is that you can redirect distribution reduction to your category peers. So when that happens, it doesn't affect you. As with anything in life, you can convert inflation into an opportunity, and you are not alone on this. So Nielsen here, we are here to help you deliver insights that explains what you're seeing in the market. I will walk you through 4 reports that you can leverage to be able to speak confidently with retailers or with other players in your industry to understand now how their wallets are getting smaller from the shoppers and what can you do to do that. So if we do a little summary, you can get comprehensive insights on how inflation is impacting performance of your brand, competition, or category with a market summary. You can understand where your buyers are coming or going from with shifting analysis. You can understand the true impact of inflation for your pricing strategy. And last but not least, and this is really, really important, you can identify the best assortment to win in distribution. So we, Nielsen, we're here to help you win. And now we're gonna open the floor for questions. So you can ask questions about inflation or how can we help or what you're seeing in the market. So I'm gonna ask Lee if we can open the floor for questions.
Yes, thanks, guys. Great presentation. We do have a few questions queued up, and all of our visitors, please continue to ask questions and we'll make sure to get to all of them. So one question that we have is, are gas prices declining due to reduced cost of gas in general or related to government intervention?
You know, I don't necessarily have a point of view on that. I would imagine it's both. I don't think that, you know, I think we have seen the demand for gas kind of bottom out as far as, you know, we'll talk about two very contrasty kind of things. So, you know, during the pandemic, when we were not driving on vacation, we weren't driving to work, you know, demand came way down. We're now in a hybrid sort of a place where, you know, at least consumer gas is, you know, we're using it at a higher level because we are driving to work, albeit not all the time. You know, we're in this hybrid working environment, but you know, it could be a little bit of both, actually. You know, demand is sort of leveled off, and government intervention is also driving some of that, I'm sure.
Okay, perfect. Thanks, Steve. Another question we have is, can you explain how to read elasticity charts?
Well, as it gets closer and closer to zero, so an elasticity number is usually stated in a negative. As it gets closer and closer to zero, it becomes perfectly elastic. So for one unit of change in price, you get 1 unit of change in
Dollars.
In dollars.
Okay, perfect. We have two that are pretty similar, but what are you seeing in price and elasticities as it relates to Bev Al, specifically beer?
Ooh, let's take that as a follow-up. We'll have somebody from our Bev Al follow up with you on that.
Okay, perfect. Another question that we have is, how do you deal with a buyer in a category that is not ensuring that your promotions allotted are being actually used?
So I guess that would mean that you're submitting promotions, but then they're not actually being executed. I think is how that's being what that question is. I'm not sure there's a lot that you can do with that. You know, it's really at the discretion of the retailer to you know, execute or move promotions around. I mean, I've had instances where I've had promotions that I thought were running and then they were shifted to another month because something else took priority, or you know, it sometimes that just happens because you know, it goes into a review process that, you know, for whatever reason, you know, maybe you didn't meet the incremental hurdles for that ad spot. But I would really be, if it were me, I would be digging into that a little more and trying to get the right people in the meeting to determine what's falling off. You know, is it are my incremental assumptions not right? Are my volumetrics not right? And there again, you know, that could be an opportunity to bring in, you know, some predictive data or more data if you're not coming in with enough to really prove your case.
And just building on what Steve's saying, another angle that we have seen happening is that sometimes that promotion is below the category threshold. So maybe you are not seeing the actual return on your investment because you are not meeting what consumers think is the right promotion value. So that is why it's important not just having a look at your promotion, but what your competitors are doing and the overall category, so you can have that baseline.
Okay, perfect. A few more that we have. This one says, as Steve mentioned, innovation can be a good way to lift sales, but how shall we look at our product life cycle on innovation items? How can we know if the innovation works? Should 1 year be a good time period to evaluate the product life cycle in our industry?
I believe that 1 year is a short time to assess the life cycle for a new innovation. You typically would like to see year 1 and year 2 to see how it is. And it also will depend on the category and the purchasing cycle. There are some products that have a very high frequency of purchase. So maybe within a year, you will see 5, 6, 7 purchases. So you will be able to assess that within a year. But in those that have a longer cycle, you will need more time to assess that.
Okay, perfect. One question that's popping up a few times is, will the presentation be shared? I'll go ahead and let you guys know that yes, the presentation will be shared after the completion of the webinar. And then we have one more as we're coming up on time. This one says, have you seen an example of brand volume gains following price increase due to elevated quality perceptions due to higher price, or do brand quality perceptions tend to stay locked regardless of relative price change?
Yes, we have. We cannot disclose the findings from other clients, but we have seen that when you have a product that has higher quality standards, especially in inflationary times, there is a group of buyers who are not just conscious about the price, but getting the best for their families or getting the best for themselves. So depending on the category, that play of higher quality can be easily leveraged just to stay within the consumer set, or actually stay at a lower price and win even in these times.
Yeah, I would say the other thing too, to add on to that, is that shoppers got really good at calculating cost per ounce, cost to own, cost per unit. And if you've got a brand that is more efficient, so take laundry detergent, there's a perception that, it could be a homogeneous kind of category. One is not necessarily better than the other, but there actually is significant differences between cheap laundry detergent and more expensive laundry detergent. And if the perception is your clothes are getting clean, the loads of laundry you're doing are less, if you can communicate any of that to your shopper to say, look, the cost to acquire is a little bit higher, but the cost to use is actually lower because you're using either less material, instead of using a full cup, you're using only a half a cup, and you can show that, the number of loads that you get out of, your detergent is more than somebody else's. There's always ways to, to talk about value, and shoppers got very comfortable with calculating their own values, and that didn't go away. Once you learn math, you usually don't forget math.
Right, and it's not just about value, it's also about the benefits, the intrinsic benefit of the product. Because right now, let's talk about very quickly the food industry. When we think about health and wellness or personal care, elements that help you to be more conscious about the environment, more conscious about your health, that can help you build that perception of quality. Okay, Lee, I guess we have 1 second for one last question, or we can close it out.
Okay, cool. Yeah, we do have another one. So this one says, as retailers are pushing brands to the EDLC programs, is there evidence how that strategy is impacting their retailer sales and brand sales on non-category leading brands?
We might have to take that one offline too. I'm not sure we know that right offhand.
Okay, perfect. Well, that seems to be most of the questions. And to everyone who asked a question, if we didn't get a chance to answer it, we will be following up with everyone. We have all of your questions recorded, so we will definitely be getting answers to everything that you guys have asked.
Okay. Thank you, everybody, for your time. We really appreciate it.
Thank you.